representatives, agents, or access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither Philstock World, Com, PSW, nor its affiliates, nor any of the respective offices, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss as you may incur as a result of information discussed in the media are identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
You know, I'm getting a little pissed off with this AI, now that I think about it. It never occurs to people, like, you should be able to, like, fire an AI, right, and get another one. So I'm actually going to test this out. Let's see, hang on. I'm going to try one. Let's see, text to speech. Well, there's plenty of them. Text to speech, right? Text to speech Google search. I mean, come on, there's got to be more advanced readers than this. Best quality for English, Spanish, bloody, bloody, blah. That's an ad, so I bet they charge money. Natural Reader. Let's see how Natural Reader does. Professional text to speech. Drag and drop. Paste your edit here. I just want to see if we can do better. All right. Let's see how she does. Speed. All right, let's just see. No, not share, just do it.
Access to this webinar is for educational and informational purposes only.
Oh, she's not bad.
Consult a licensed broker or registered investment advisor before placing any trades.
Faster.
Consult a licensed broker or registered investment advisor before placing any trades.
How about that?
Consult a licensed broker or registered investment advisor before placing any trades.
All right, we'll try 3.
All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor...
See, she says the dot. The other guy doesn't even say the dot, which I think is very stupid. All right, let's see. English. Rachel. Oh, I know an English girl named Rachel. Let's see how she does.
Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives.
Nah, she's too slow. How about Gabrielle English? Is it the same girl?
Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of the respective...
It's that guy again. He's the one we don't like. All right, well, this one's promising. Let me keep that up for next time. I'm going to see if we can find a better AI. See, AI is just like people. You just have to keep interviewing them until you find a good one. And you don't feel bad when you fire them, I guess. All right, so there was a question. Johnson, what do you think will happen with oil after the holiday? Ew, I don't know. That's tricky. Let's see what happened today. We had a petroleum status report. Dun, dun, dun. Weekly petroleum status report. Oh, I'm going to have to reboot this computer at some point. It's slow. My vast knowledge of computers, when it's slow, reboot it. End of story. All right. May 11th, that sounds right. Okay. And oil's at, look at gasoline. Gasoline, $2.23 basically. Oil's where it was yesterday. Gasoline ripped up to 223, and that's because the headline report, as noted in today's post, which I just put up, not the post, but the thing about the oil. If I can ever find my elevator, there it is. So the EIA showed a small draw in crude, but a large draw in gasoline, and distillates were a small draw too. So net, you're still talking about a 5 million barrel net draw. It's a serious draw. But when you look at the report, let's see what's going on, because last week it was all shenanigans. Here, as you can see, it went from 9.7 to 7.6. So the net draw here is only 2.1 million barrels. So once again, we can blame all other oils. You see what they're doing? This is the same thing as last week. 5 million barrels, again, are pushed into all other oils in inventory. So they're taking oil and putting it into all other oils to jack up that inventory, and then the headline shows that they made, of course, it's the same oil. It's the same 20 million barrels as last week. So when they take 5 million barrels and put it into all other oils, it takes it away from the other stuff. It's so not confusing at all, yet nobody in the press covers this kind of crap, and it really pisses me off. And I pointed it out to press people too. I mean, I've pointed this out to reporters several times, and they're like, wow, I've never heard of that, and then they never write about it, though. So it somehow gets kicked out at the top. I don't want to say there's some vast conspiracy, but, keep in mind that the oil companies are major advertisers for all these publications, and they don't want this kind of crap. We exported a little bit less, 100, 200, 100 something thousand barrels less, so maybe 1 million barrels less exports. We imported less. Oh, again, we imported less. Holy crap. We imported, though, 300 less thousand barrels a day. So 2.1 million less imports accounts for the entire net draw in crude. All right, so the reality is it's just games that they're playing to jam up the price of gas into the holiday. Last year at the holiday, gasoline was $2.36. Now it's $2.80, so 50 cents more. So more than 20%, about 25% more than it was last year at the same time. So in answering the question, what's going to happen after the holiday, aside from saying, I don't freaking know, wait, now let's take a look and try to make an educated guess. Last year after the holiday, we had a run up into May. Here's the holiday, and it crashed. So that bodes well, because it's probably not sustainable. And last year we had the holiday run up as we're having right now, the same exact thing, the same amount basically. It doesn't matter where you start from. They just they just do these shenanigans. Look at this pattern. Look how similar that pattern is to this pattern. So we're in this leg now. See this leg over here where they really stick it to you right into the holiday weekend? So you don't want to get in the way of this thing, but when it does top out, so maybe next week, it's tricky. Maybe we are going to have to find out when exactly oil is trading over the weekend. So in other words, like next Monday's a holiday. So I imagine we're going to trade all the way up until Friday next week. So Friday, right into the close, if oil is still jammed up, if it's like 230 on Friday, I think it's going to be a great short. Or 225, anywhere around there. I mean, because you're really pushing $3 a gallon, and people will tank up for the holidays. It's not gonna. You can't stop. Nobody's gonna not go to the shore because the gas went from $2.50 to $3. Times 20 gallons, it's $10 more. That's not gonna make you cancel your shore vacation. But when you come back, it makes people more cautious. And by the way, Americans have only themselves to blame for this, because these idiots. I don't want to say you idiots because I'm being nice, but these idiots in America, not us, of course. I actually did just buy an SUV. They all ran out and bought SUVs. As soon as gas got cheap again, everybody ran out, and right here, to the point where Ford doesn't even make cars anymore. I mean, like a regular car. Ford is no longer making cars because they don't make any money on them and nobody wants them. SUVs, all SUVs, mini SUVs, whatever. It's crazy. And now they're going to make electric SUVs, so I guess they figure they don't have to worry about the mileage problems that they would have usually. But for now, the manufacturers are dropping gasoline SUVs like you would not believe. And people are buying them in droves. I mean, I live in North Jersey, and I was actually looking at a parking lot at the at my local grocery store, and I was just sitting there because I was waiting for my kids for something, and literally 3 out of 4 cars are SUVs, which is completely now. If you say to me, Phil, do you really need an SUV? I'm like, yeah, I do. My SUV is packed. I'm a suburban dad, so my car is often full of kids and stuff and sports equipment and whatever. So if anything, I've contemplated getting a bigger car. My SUV, by the way, is a Porsche Cayenne, so but still, it's an SUV. But you know, my car is packed to the gills on a regular occasion, so I would never say I don't need an SUV. And obviously, my wife has the same thing. She just goes in a different direction with a different set of kids. So we're a 2 SUV family. She's got the Volvo thing. So I was just kind of curious. I was thinking about that. Now, obviously not everybody in my town has kids, so they don't all need them. But I also realized, like, if you don't have an SUV, and I've had an SUV for 20 years now, so you know it's hard to say. But if you don't have an SUV, you feel small on the road. You know, I mean, most cars are SUVs. They're bigger, and that makes, and I can understand the reasoning where people who don't even need an SUV would be like, well, I don't want to have a tiny little car with all these idiots driving around me in trucks. So it's a problem, and we don't have the proper incentives to get people to stop buying these things. We also, though, don't have, and it goes back to the same thing, that we don't have the transportation infrastructure to allow us to not be the driver of kids. If there were good buses and stuff like in other countries and good trains, the kids would be able to get back and forth to their own schools and their own practices, and they wouldn't need parents to take them wherever they want to go. And my kids take Uber a lot, but that's, you know, beside the point. But I'm saying, just even if it's, you know, even normal parents who don't like give their kids Uber cards, you know, it's it really is weird. It's like just the incentives that drive us in this country are geared towards increasing the consumption. So it's a very odd situation, and I don't know how easy it's going to be to solve. Certainly not in the suburbs, and well, that's where most of the cars are. Of course, there aren't as many cars in the cities. And good God, in New York, it costs $300 a month to park your car, and that's getting a decent price. That's just for your car. And so if you have 2 cars, it's $600 a month. That's crazy. Anywho, all right. So, oh, I'm sorry. What was the question? The question was gasoline. Forgot the question. So, so like I said, yeah. So next Friday, I think we might want to take a poke short. But until then, I don't see any reason why they won't be able to jam it up like they always do into a holiday. Look, here's the Memorial, the other holiday in September. Look what they do. Boom, 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 boom. And then it fell apart. Look at it. The day after it falls apart. I mean, it's just such a scam, because this is what you get charged at the pump. And that's it's almost 20 cents higher. Whatever they close at that weekend is what you get charged over the holiday weekend. Then it comes back down to a more realistic price. I'm not sure why it got jammed up again, but they got jammed up again. And then falls off a cliff because it was all bullshit. And this is all bullshit. I mean, some of this is the idea of the OPEC, Iran, blah, 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 whatever. But this little thing here, this little ramp up into the holiday, it's bullshit. Thanksgiving too. Here's the Thanksgiving run-up. See how they all follow the same pattern? It's the same robots doing the same job to screw you the same way. That's how it all works. So anyway, so then again, when you see a pattern like that, you say, "Gosh, I can make a lot of money betting against that." You got to be careful, but we'll take a look at it. Certainly next week, it'll be a big topic of discussion because that's when we want to consider the bets. And you can mitigate your damages by taking the USO SCO trade. So like SCO, for example, is the ultra short oil. So hang on, let me pull up a. SCO. What's wrong with this thing? Why is that not working? FinViz. Well, that's weird. I've never seen a chart like that. What are we talking about? SCO? It's a little different than their usual charts. Okay, so SCO is like crashed at 16. Now, I believe it's a 2x short. Yahoo should be able to tell me this. SCO and profile and 2 times. Okay, right. So it's a 2x short. So SCO is a 2x short on oil. It's getting hammered, but let's think about this. At the beginning of April, it was 20. Now it's 16. So it's fallen 40%. No, wait, 40%. 20% since the beginning of April. And oil, oil. Actually, oil's though not as good as shorting gasoline, but I'm just, for the point of. So oil has gone up since April from 63, I'd say 63.50 to 71 is like $8, $7.50. So more than 10%. So basically, yeah, there's a good relationship there. Okay, so it's right about the correct relationship is 10%. So what's your danger? I don't think oil is going to go past 75. 75 is $4 is like 5%. So 10% worse on SCO is probably your worst case. So we're not going to go much below 15, maybe 14.50, something like that. So then you look to SCO, and I know there's a gasoline one called UGA, but I don't like it. So we'll talk about that. I like SCO. I trust. I don't trust the UGA. Trade all products. SCO. And what's our time frame? Our time frame is into June. And what did we say? We said it shouldn't go lower than 14.50. And we think it's going to go up higher. So what realistically now? Oh, and by the way, what do we expect as far as gains? Well, let's say oil pulls back 10%. That'll give us a 20% pop in SCO, which is now at 16. But let's say it drops to 15 first, then goes back up 20%, will be 18. So our target is 18. And we can go lower. So we can now, you just got to look at the relationship. So the 15-17 spread is about $1. The 16-14 spread, well, I wouldn't go by that number. That's a weird number. If this is $1.55, that shouldn't be 240. Actually, you can see the delta 72. So add 75 to that is 161, 230. Well, actually, yeah, like 230. So it's still not too low. So that's actually not unrealistic. So 230, and then you sell that for $1 is $1.30 for that spread. So no, I'd much rather take this spread. So in that case, I would take the 15. Don't forget, you're at 16. So if all goes well, you're in good shape. You take the 15, which is $1.50, and you sell the 17 for 50, or $1.55, 55, whatever. You try to net $1 on the spread, and then basically you're right at the money on oil. And it may go down a bit, and if it goes down, that's when you want to make the roll, because then you can make the roll for hopefully 50 cents for the dollar. Then it would be worth it. It's not worth it to spend another dollar. That's silly. Why would you spend $1 to be $1 lower? It doesn't make any sense. But if you can spend 50 cents to roll down because it gets weaker, that would be great. But conceptually, the way you start is you take the 15-17 bull call spread for $1. That's your position. So if oil doesn't go higher, and don't forget, we're not showing big demand here. This is right before the holiday weekend. If anything, the refiners, see, here's the thing. You have to think of the mechanics of the entire thing. What's going on? The gas stations want to make sure their tanks are tops off well before next week. People are going to start buying gas next Wednesday for the holiday weekend. They're going to buy gas on Wednesday, and they're going to come back and need gas again, maybe, from their trips. So the gas stations want to make sure they got plenty of gas by next Wednesday. So they're already ordering the gas. So it's shipping out of the refineries. So it takes time to get to them. It takes a week, 3 days to get to them. So there's a lot of orders already in progress. So there's certainly a demand for gasoline. That's not a surprise. And also, though, they're trying to time the market. So a lot of these guys, a lot of the gas stations may have kind of put off buying. They're not really good at playing the futures, but they may have put off buying because the price kept going up, but now it keeps going up more, and at some point they have to capitulate and buy. So there is demand, and there may be more pent-up demand for people who are last minute and waiting, but the maximum demand is going to be right now, this week, and the report we just had and the next report is going to be your maximum demand for gasoline. Then it becomes a question of how much gasoline actually gets used on the holiday driving weekend. We have no idea. It's supposed to be probably good or, strong demand. So then they'll have to refill their tanks. If there's strong demand, people have to refill their tanks, and you'll get another pop after the holiday. Not a pop, but you'll still get some good draws after the holiday of gasoline. So that's where we are. So mechanically, you figure that the next report we get next week is going to be the last big one as far as drawing gasoline down. Then it might actually go the other way, because if people end up with too much gas, if they don't have the kind of demand they anticipate, they're going to be stuck with a lot of gas. And even worse, if the price goes down, like right now, because they're not screwing just the consumers at the pump, they're screwing the gas station owners too. The gas station owners have to buy gas. Can't have no gas. So they have to buy at the maximum price when as it's hitting now, and then they've got to sell it. And God forbid the prices start dropping while they're trying to sell it, they can actually get hit on the prices. So. And that's a really complex dynamic because, the guy who buys this week is at a disadvantage to the guy who buys next week, and they're all trying to time it as best they can. I mean, it's a kind of business where a couple of pennies a gallon matters a lot. Anyhow, so the bottom line is that this might not be it. We might get another leg up as far as oil and gasoline prices. And of course, at any time, the whole thing can get blown by Trump saying something, or Iraq firing missiles, or who knows what goes on, or Iran doing something. But at the moment, that's why I wouldn't want to spend extra money to be lower, because you'll just get hurt more if it goes down. But if you do this spread for $1, let's say we drop $1, then you'd have the value of the 16-18 spread, right? Logically. So the 16's a 90, and these are 30, so 60. So you can lose 40 cents. You can lose 40% if oil drops $1. But then what would you do? Then you would roll. You would spend 50 cents to roll to the 15s. I'm sorry, roll the 15s to the 14s. Sorry about that. And then you'd have the 14-17 spread, which is good for $3 if it ultimately recovers. And you will have spent $1.50 net, and you'd still be down the same 40 cents. So it's not a terrible way to play it. I think that's definitely the way I'd go. So in other words, the start is you take the 15-17 bull call spread for $1. If oil drops to 15, you roll down to the 14. So you stay $1 in the money. And as long as if that holds, if 15 holds, you'll recover $1 out of the $1.50 net that you're spending. So that's not a terrible thing. So I mean, still lose 30%. But I mean, as long as 15 holds, you're still going to hold the 30%. But then you've got potentially $2 of upside from where you are. So so either way, if it goes your way right away, you can double, or if it goes your way after it dips, you can double. I like that kind of trade. So that's that trade. All right, that was one question answered. How long did that take? Let's see if we can do another question in the next half hour. Good thing there's only one more question. What is your? All right, good. We can quit early. What is your price target on silver? I imagine SIN8. Or when would you think about lightening up? I don't have targets. I don't know why everyone says, "What's your target? What's your target?" I mean, my target is to, look. I'm going to look at the chart of silver, metals, silver. And I'm going to say, well, gosh, silver has often been above 1650. In fact, I really think it should hit 1650. So I'm not too psyched to sell below 1650. It has gone up to 17, but I think, look, 1675 seems really realistic, right? So I would probably take half at 1650 and then try to let the other one ride and hopefully get a big punch to 17. But, whatever. But the point is, I don't have a target. What if it's getting weaker now? What if it's this kind of thing? If you ask me here what my target was, right? Here, if you ask me here what my target was, I would say my target is 17 and hopefully 1750-ish, or at least 1725. But then it goes down and down and down. I gotta say, oh, that's not working out. Now, if I'd stuck with it and kept my target at 17 to 1725, ultimately, after a really stressful month, it would have worked out. But you know what I mean. So I think silver, though, in this case is down only because the dollar, so you can keep this in your head, okay? We're down from, down about, that's not even 10% of it. It's only like 5% or 8%, whatever it is. So we're down about 8% from the high, right? The dollar in the same time period is up, go away, is up from 89 to 93, 4. So the dollar's up 5% since middle of April. That's crazy. Don't forget, this is a $100 trillion currency that gained $5 trillion in value in a month. That's crazy. That's 5% of the global GDP. Our global GDP doesn't grow 5% in a year. So where does this money come from? It comes from nowhere. It doesn't exist. It's not real. We've always done is devalue the rest of the planet by 5%. And that's what's going to happen. The global GDP priced in dollars is going down if this persists. So we'll see. It'll be interesting. But so in other words, bottom line is that it's really all about the dollar. So if it's only because the dollar is repricing silver, then let me I can't do a good double. I mean, unfortunately, I have to go back and forth. See here in September, all right, we had a similar kind of move, basically September, November. So let's see what happened from September to November. We had a similar move. And let's see what happened to silver then. So look, September to November, see what happened to it? It stopped going down though, because the dollar kind of eased off. So it kept trying to bounce. So it's good to pick it up. When the dollar is causing the drop, it's good to get on it and stick with it. I don't even know what happened here. That has nothing to do with the dollar, I don't think. It wasn't a spike in the dollar. Not really, a little move up, but I wouldn't call that. But the September to November thing was a big one, because that's when the dollar came up. No, actually, well, no, not really. All right, so the dollar actually came up. Point is, that when you move, and obviously we've read looking for other reasons silver did this, but you can see everything's just moving lockstep. Platinum, silver, gold, everything's moving down in lockstep. And you know they all want to be higher, especially if you read all the inflation news and everything else. So that makes it a good time to buy. And also after a 5% move in the dollar, what do we expect? What does the 5% rule tell us? The 5% rule tells us we should get a 1% pullback. So now we're going to go to a shorter term chart and look at the dollar. No, not the dollar. So 93 to 99, 93. Oh, I'm sorry, back here. So 91.25 to 93.50 in this case. That's not going to be it's probably 2.5%. Calculator. So what do we say? 93.50 to 91.25 is 225, right? Yeah, so it's going to be 2.5%. 2.25 divided by 91.25 is 2. You see that? And that's the 5% rule. Don't forget the 5% rule breaks down to 2.5% and 1.25%, especially on things that are liquid. So, and dollar is very liquid. 4 trillion a day is traded. So now we've got to move from 93.59. So we've got to move 2.25 times 0.2 is 0.45. So pullback wise, we're going to get a weak retrace to the 93.05 line. See, look at that. Oh, there's the 93.05 right there. So we get the weak retrace to 93.05, and another 45 cents down would be 60, right? So 92.60. So a strong retrace would come up to this 92.60 line, which is actually right there. It's funny. That's where it is. So this line, so you can see on the way up these lines worked, and it worked over here, 92.60, and 93.05 got rejected back here. 93.05, it popped a little over, but came right back down. 93.05 again. So you can see these lines are in place. So 92.60, so weak rejection is going to be 93.05. Strong rejection is going to be 92.60, but still bullish as long as 92.60 holds. Just bullish consolidation. It's forming, what it means is it's forming a new range at a higher level. So here, look, see 92.55. I'm sorry, not 92.55, 92.60. 92.60 was a ceiling. It punched through it. Eventually gets up to new highs. And now, to confirm that new high, 92.60 has to hold as a bottom. And that would mean we're going to break over that eventually, too. But, that's all stuff to worry about. You're talking about, it's a month-long process. No, I'm sorry, not month, days. There's days of process. So it's not like it's going to happen tomorrow or anything. You just got to watch for it. So in the gist of it, though, is over the same period of time, basically, you expect to retest 92.60. So in 2 days, basically in 2 days, if we test 92.60 and make it, it's going to be bullish for the dollar. If we don't even get there, if we stay above 93.05 and start heading up, I would also bet for a breakout to a higher level. So we will see what happens. And also, again, that's just the charty technical thing. But what's really more important, though, is why is the dollar breaking up? Well, the dollar is breaking up because Venezuela is collapsing. Italy is possibly in default of their loans. They're asking the ECB to forgive $250 billion worth of debts. There's a trade war with China, which is bad for the Chinese currency. Japan, their economy is slowing down, which means that the Bank of Japan may further dilute the yen to give them to help the manufacturers. And of course, the UK is dealing with their Brexit bullshit. And the euro, aside from having to bail out Italy first of all, Draghi keeps saying, both Draghi and Carney keep saying, we don't give a shit what the economy looks like. We're going to keep easing. That's pretty much their stance on this. They're like, there's no such thing as tightening. So given that, on what basis would the dollar go down? It's got to be strong compared to every other currency. We're raising. Our Fed is telling you we're raising our rates. We're tightening our money supply. So if we're the only people on the planet tightening the money supply, of course our currency is going to get stronger compared to everybody else. And there's everybody else, down, 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 down. If your bank is tightening and other banks are not tightening, your currency will get stronger. This is not complicated. If your currency is stronger, it puts pressure on commodities. It doesn't stop a commodity from going out of control, but it does help a bit. Speaking of commodities, what else do we have going on here? So we have, oh, silly me. So we have, so Arby, I mean, it's really tempting to short it here, but it's just so scary at this particular time of year. And plus you have Brent's pushing a high here, so you gotta stay away from it. Gold, though, like I said, bargain. Silver, bargain. We're already in silver. Oh, look at that, nice. Coffee, KC something. I'm just trading this silver contract. I'm not sure which one it is, but just the current. I'm just trading the current contract. So I'm not planning on being in it for any huge amount of time. We're out of natural gas at the moment, so we haven't had a good pullback. What was the other thing we were looking at? KC, but not the current coffee. KCU8, right? No, V8, sorry. KCV8, no? Oh, because I didn't do the dash. It was U, sorry. U, there we go. All right, so KCU8 is the other one that we're liking. This is coffee. And my premise on coffee is eventually something's going to happen that's going to disrupt the planting. Either it could be a drought, it could be a flood. It's just, coffee's very sensitive. So any bad weather situation can do it. In fact, yesterday, the temperature fell from 92 in the afternoon, it was 92. And at 4 o'clock, I know it was 4 o'clock, we were just done with the market. At 4 o'clock, the temperature dropped to like 60. So like 30 something degrees down in a couple of hours, and a storm hit us that was like a hurricane. And the house was shaking and there was lightning everywhere. It was crazy. You know, so things like that are bad for sensitive crops. And the world's weather is going kind of crazy because of the global warming that doesn't exist. So something will affect the coffee crop at some point, aside from just the overall demand. And Starbucks, by the way, is gung-ho bullish opening in China. So there's a lot of Chinese people. If they can get them to drink coffee, there's going to be a huge demand spike. And I know everybody says China, 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 but really China. I mean, they're not coffee drinkers. If you can change, if you've got a multi-billion-dollar corporation that's going to put a big ad campaign into coffee. I remember when I spoke to Muthu Kent, the CEO of Coca-Cola at the time, and we were talking about sugar, and it's Coca-Cola's fault that that everybody has to use high fructose corn syrup, because if they switched to sugar, they would use the entire world supply of sugar. One company. You don't realize that with some of these things. Like, just Coca-Cola alone, if they actually put sugar in all their drinks, they would use the entire world supply of sugar. So it's not a small thing. One company can make a giant difference. And so Starbucks, a big company too, going into China and marketing to change the taste of Chinese people, to get Chinese people to start drinking coffee instead of tea. If they strike the right note and they get people in China to think it's trendy and cool to go to Starbucks, and they sell their brand, and it doesn't matter if there's competition sprouts up and a lot of other coffee shops opening up. That's the point, though. It's we care about the commodity. If people are drinking coffee, that's good for us as coffee investors. Now, very volatile stuff, but you look at this over the long haul, and we are pretty low range historically. Okay. There was a weird spike that caused a lot of growers to plant, and there was a glut for a long time, then it evened out, whatever. This spike was caused by the weirdest thing. This spike in coffee was caused by Keurig, you know, the 1 cup coffee guys. When those 1 cup things came out, think about what happened to your supermarket shelves. All of a sudden, your supermarket shelves were filled with coffee pods. And that means that these companies had to have warehouses and warehouses and warehouses filled with coffee pods. So there was a demand, it wasn't, you weren't increasing the demand of coffee, of cups per person, although maybe people did drink a bit more coffee. But what you were doing instead was shifting forward. So these guys are pre-ordering coffee that people were going to drink in 6 or so months. So when these companies, Peet's and Keurig and everybody else, went public and started putting in these pods and opening up their stores all over the place, they needed massive amounts of coffee. And so we had this sort of coffee craze, plus Starbucks was expanding and blah, blah, blah. We had this coffee craze for a while that caused a pre-demand, because once a store opens in Starbucks, or once you stock the shelves at, and you've seen them at Costco, like packed to the gills, it's like a 10-year supply of coffee for a whole town. It's sitting in Costco. Once those shelves are filled, then there's only the replacements, and that's why it all falls apart and goes all the way back to the other way, and then it evens out at some point. So all of this is here. We're just investing down here. Whenever it gets down this low, we invest down here, and we just wait for the next spike. And if we're lucky, we'll catch one that goes like that instead of just one that goes like this, or one that goes like this. I mean, frankly, this is $1.50. If you get a 10-cent run in coffee, you make a fortune. So, we don't need a big move. We just need a move. But if we're lucky and we catch a $100 run in coffee, that's like, I don't even know. It's some giant amount. Anyways, like $20,000, $30,000 a contract. The thing is, you're not likely to have a terribly bad run, not one that lasts, but you're very likely to have a good run. So why not play as often as possible? It's not a complicated strategy. It's just you're more likely to win than lose. Well, how did I put this? Okay. It's like betting your driveway won't be covered in ice. Let's say you live obviously if you live in Florida, it's a good bet. If you live in the Northeast, I can say my driveway won't be covered in ice. And usually it's not covered in ice. Sometimes it's covered in ice and it goes down. They're like, aha, you bet against it and it's covered in ice. Then the ice melts and I go, aha, it's fine. Then all summer it's fine. Then it gets icy again. And I go, aha, well, I guess I'll make more bets that my driveway will not be covered in ice in the future. And then I go, haha, it's not covered in ice. Then it gets covered in ice again. And I go, aha, I'm going to bet a lot again when it is covered in ice. When I'm wrong, I'm going to bet more. And then when it's no longer covered in ice, I go, aha, see, I won. That's it. It's not complicated. It's freaking seasonal variations, demand variations. It just goes on in cycles, and you just bet the cycle. The problem is now, of course, you don't want to get over your head because it could go far against you. You could have an extremely cold winter. You could have the first snow in October and the last snow in April and be very surprised. Like this season, there's going to be skiing in Spore Valley and in, where the hell was I? In Whistler. They're going to have skiing on July 4th because they had so much snow this winter. They're going to ski all the way to July 4th. So if that was your bet and you had to hold out and you were getting screwed all the way until July 4th, you'd be pretty upset. So it is certainly possible these things go against you for longer than you thought they would. But eventually the sun comes out and you make some money. The trick is not to jump in at the wrong time. So we wait until it's at the low ends of the curve. And these are years, but like I said, we're really looking at the daily chart basically. And whenever it's in the along this declining line. So we're not saying that whenever it's here, we bet. Basically on this declining line, we keep setting our sights lower, we jump in. So we only just jumped into coffee here. Actually, here at the 120 line we started, and now I'm sorry, we're on the U cycle, so we're actually it's still at 120 in the U cycle, because it's further out in time. But this is about where we did just jump in. Like a couple of days ago, we jumped back into coffee, and it went down a little bit since then, so we're a little bit behind. But we're going to just keep buying more until it starts coming back up, and we're going to take our money and run when it gets back up to here, because that's plenty of money. All right, if it makes a massive move, if it busts over and we haven't gotten rid of all our contracts, we'll hold on and see how far it goes. But for now, we've been successfully this whole time making a penny, couple of pennies, a penny, a few pennies, penny, whatever. We don't care. A couple of pennies is great in coffee. You can't play just, you can't play saying I only want to make a $50,000 winner. No, take 500, 1,000, 500,000. You can do that 50 times. It's easier to do that. I can look 1, 2, 3, 4. Doesn't count. 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, about 15 times. That's about right, too. Almost close to once a week. We do this. We do the coffee trade. Whenever it goes down, we take it. Whenever it goes up, we get out. So 15 times we've made, let's say, $500. So that's $7,500 instead of waiting one time to try to make 10,000. It's very easy to make $500, $1,000. It's very hard to make $10,000. That only happened here and here. And maybe even not really here. Well, I don't think it's $10,000. But let's say this one and this one were good for 10,000. So you have to hold it, you have to stay in it, you have to ride out the dip. It's not that likely. This one was easy because if you're in it, it just went up and up and up and up and up. That doesn't happen that often. But this happens all the time. Little bump, little bump, little bump. That's how you play it. All right. I thought that was the last question. I was going to wrap it up. All right. Alistair says, Alistair, is that how you say it? He has a TZA 11-15 bull call spread, July, for the portfolio protection. He wants to maintain the hedge, move to 913 through the summer. When is it appropriate to roll, say, October? What? Roll to, say, October. Oh, okay. No, wait. I believe you said in the past you want to roll before the call. No. You want to roll before the call drops below the net of the spread. So, in other words, TZA, which is probably not in very good shape, frankly. TZA. Okay. So he's saying he has a July, 11-15, which is a very wide spread, so probably not going well for him. You have the July 11-15 spread, which is currently, it doesn't matter what it is currently, frankly. Let's say you spent $1 on it. Okay, just for example. So let's say you spent $1 on it. The idea is to roll it before the 11 drops below $1. So, let's say this one was $2 and the 15s were $1. So netted $1, right? You net $1 on the spread. But then when the 11 drops to $1, that's when you want to roll, because basically what you're doing there is recovering your $1. You only spent $1 and you're going to recover $1, and then you're going to move to the October whatever's, it doesn't matter, that let's say that, let's say the 8s are $2. So you're going to spend another $1 and roll to the October 8s. But you know what? You've got your original $1 back and you spent that. So you have your full value in the new position. You understand? You've taken it away. You still have the short puts, the short calls, but they are now the short calls you have on the thing. And when they expire, you can then sell something else to bring the price down. But you've got your full value in the position, but only if you make the roll before the call drops below the net you paid for the spread. All right, so my answer to your question, which is when do I roll, or when, it's like the answer is it's too late. It's not really too late, but it's too late to do the proper thing. But that doesn't mean you still don't want to salvage what you have. So you've got in the July, June, what did you say? July TZA 11. So in the July 11s, you still have 35, 38 cents of value. Doesn't matter what it is, you still salvage that value. So you take that 38-cent thing, you add $1 to it, and you see, what can I get for $1.38 in October? You can get the October 9s. So you're going to roll your July 11s. This is actually a good story, though. You're going to roll your July 11s, which are out of the money, to the October 9s that are almost $1 in the money for $1. So you're getting fair value for your dollar. You still have the short July 15s, but they're not very valuable. And frankly, whenever you feel like it, you can sell the 12s, which are currently 60 cents, or the 13s, which are 50 cents, and you drop your net back to about $1. And then you do it properly next time. But that's all you do. You just keep doing that over and over again. And you're spending money on the insurance each month, but you're banking it and you're creating a deeper and deeper position that gives you better and better protection. But that's the key too. Don't just roll to more premium. We want to sell premium, and you're not going to sell premium if you're out of position. So you've got to roll yourself to a value position where it has little premium on your part, that you can then turn around and sell premium to someone else. It had a great one from yesterday, says Brendan. I assume he means, what does he mean, silver or coffee? I guess he means silver. So he has said something about silver before. Did you get executed on, did I get executed on OPK? I did not. Yeah, we got that. That wasn't hard to get. It's pretty well traded. OPK, that one came in. I mean, not at the exact prices, I don't think. They came in. Anyway, we have not had a problem trading that. Phil, not your usual type of question you get asked. Okay. When picking index bets, using Index Direct's SPX instead of ETF seems to have 23% versus 40% capital gains tax rate difference, or so I've been told. Curious if you consider this. I don't, because if you trade through a company, if you trade through a hedge fund, or you trade through a private trading company that you set up, these are not an issue. You basically just have a P&L for the year, and you get taxed as a corporation. You can have a private family office fund that trades. There's all kinds of ways you can set that up. So I haven't considered it myself. I don't know that it's true, but obviously, if one has a lower tax than the other, then you're saying you're saying that SPX, if you trade it, has a lower tax rate than. That doesn't make any. I don't know. If that's true, then obviously I would trade the one that has lower taxes, but I don't. Phil, I need help with my LB trade. I took the LB trade I believe you recommended in the BNN portfolio strikes. So I have the long LB 3250. Okay, wait. If it's possible, we can hopefully look this up. So let's try to find the BNN portfolio. Money Talk, she means portfolio. Okay. And she says, LB. I have the long LB 3250 calls. We have those. I have the, at 6, we have them at 750, so she's in better shape than we are. I have short LB at 350. We have them at 430, so pretty much the same. And the 3250 puts. at $7.99. Wow, you got a way better position than we do. Oh, because these are 2019s also. That's a difference. Anyway, should I close it out or leave it as is? I noticed you made an adjustment in the OOP for the LB today, going to the LB 30 puts, and you have going to. All right, well, we're not making a change in this portfolio because it's for the TV show Money Talk, and if I'm not on the TV show, I can't make a change. I don't have a way to reach the people who follow this portfolio other than to get on the TV show and announce we're going to make a change. So it's very sporadic. I'm only on about once a quarter, so this won't get actually changed. But and we're still up 70%, even though we only touch them once a quarter. I think that's great. Since when? Since September, I think, right? We started in September. We're up 70%, and it's only been touched like twice, I think, at all. So, step one, leave it alone, is good advice. Now, if you want to be more aggressive, then you're talking about more like the OOP trade. And today, in chat, did I do that in the OOP or was it the LTP? I'm confused. You made an adjustment in the OOP for LB today. I don't think I told the OOP people that. Oh, man. That's bad. All right, anyway. The adjustment was, and I don't think we did it officially in the LTP either, but the adjustment was since earnings are coming up, I believe what I said was, well, I could look it up. Hang on a second. Let's see what I said. Control F, LB. I thought I meant to get back to it, but then I got so busy. Not that. Oh, here it is. Oh, it was in the review. Oh, good. I did tell the OOP people. I'm sorry. I was doing a review. And earnings of 523. So that's why I figured we had time for the LTP review will be out before this too. So it's good. I did notify the OOP people because it's obviously in the review that they got. So I said very simply, let's get aggressive and buy back the short 45 calls. And in this case, we have the short 45 calls. Why? Because we sold them for $850 and now they are $270. So, all right, look, LB. See, my problem is I know this stuff without looking at it, but then I realized like I should probably explain it to you guys. All right, the $45, not puts, calls, the $45 calls on LB at $250 only have a 31 delta. So if LB drops 10%, $3, it's only going to drop the price of these things by $1. So by uncovering it, my risk is not $250. My risk is only the $1 that it might drop. In other words, if I kept it open and LB drops 10%, then I will not benefit the $1 that it drops against my short calls, right? But here's the thing. If it goes up $1, if it goes up 10%, then I have the uncovered 3250 calls and I'm able to possibly sell them because they're going to go up $1.50 or so, or I can then sell a cover. Possibly, depending on what the earnings tell me, I might want to sell lower calls for higher prices, or I may sell these calls for a higher price for $3. Either way, though, there's a lot more ways I can be in a much better position doing it that way. So it's worth it to have the flexibility. All I'm risking is $1,000. By buying 10 back, I'm not risking $2,500. Really, obviously it could drop more than 10%, but I don't think it will. If it drops 10%, I'm only risking the money I would have made from $250, which is only $1. So it's not a big risk. I'm only risking $1,000. Now, step two is I said, we should roll the $35 calls, because those are now $540, to the 30 calls, which are, well, now they're $760, but they were like, wait, $540? No. $420. All right. Whatever. Let's say these are $450 and these are $750. So let's say it's $3 now. It was $250 earlier. But let's say even for $3, though, at least I'm buying $5 of in-the-money premium. So what am I changing here? I'm buying $3 of premium. I'm running my delta up from 45 to 64. Is that right? No, sorry, to 57. That's only 0.12. So what's my risk now? If the stock drops $3, I'm going to lose 0.12 more than I would have lost, which is 36. So I'm going to lose $360 more than I would have lost if I left them over here. But gain-wise, I'm going to make 360, and I'm in a much better position, and then I can cover with a much more expensive put. With a much more expensive short call. So it's all about what I'm really buying here. I'm taking not much risk. I'm risking $1,300, $1,500 if things go wrong. The fact that I'm putting additional money in doesn't mean I'm risking more. The fact that I'm putting additional money in just puts me in a better position. It doesn't increase my risk. But it does set me up that if LB punches up 10% to 37.50, and I can sell the $40 calls for the price of these calls, so let's say $450, then what have I done? Then I've traded in my short 250 calls for short 450 calls, which have paid for more than the entire roll down. So I've decreased the basis of my spread, lowered the strike price of my spread, and taken money off the table. So that's my reward compared to my $1,300 risk. I'm happy to take that risk against that incredibly great reward. And especially, obviously, because I do believe that LB is going to go higher. All right, so that's the long answer to that. I don't bother explaining all that. It takes so long to explain. If I did that for every time we made a move, it would be like I'd be here forever. But that's the gist of it. Okay, so that's the longer story of why we're doing this. So, you know, should you do it? I mean, I think it's a good idea. I think it's definitely the way to go when you have a trade like that. But again, we're taking a bit of a more risk into earnings, but it's what I like. All right, the BNN, we're not going to obviously change the BNN portfolio at all because I'm not there to change it on the show. All right, you're welcome, Alistair. Alistair. I don't know why I can't get my head around that name, Alistair. Okay, I don't get those prices. Oh, Brendan didn't get those prices. Yeah, but you know, it's first of all, you gotta play it. You're not going to get everything every time, but if you go OPK, and what do we sell? Damn it. OPK. There it is. No, not you. Damn it. That one. Okay. So with OPK, which is in the LTP, right? Ooh, 15%. Very nice. We're moving up on that one. Why is the market up? Oh, yeah, it is. 95 points. OPK. There it is. All right. So the January $3 calls, $1.80. The point was to get a dollar spread on the 3-7 spread, okay? So it doesn't matter what the price actually is, but what you want to do is go to the January 3s. Let me close this down for a second. What? Oh, it really took off. Holy shit. Well, you're not going to get those prices now. It was like miles above where we were. Copy. Copy that. Okay. Wow, did that thing take off. Futures traders, charts, profit, flexible grid. That's it. I'm going to paste this in here, Control V. And here's how that option's been going. I mean, it went through the roof. I mean, what do you? There's no way you're going to get that. We did this one on the 9th. So where's? Oh, this is a weekly. No wonder, stupid thing. Let's do 10 days. All right, where's the 9th? 5859. Okay, so we did it on the 9th. And here's 180. And then it went to 190 and $2. So, you know, that whole day, there was hours where it was between 180 and $2. Now it's 275. It's a totally different ball game now. You're never gonna. I mean, the price is different, but still, okay. So whatever. So it's easy to do now, and we'll see how hard it is now. So it's 260, 275 for the last 2 days. So meanwhile, the sevens. So we now change that to the 7, and the sevens on the 9th were 80. So you see 180, 80, 190, 90. It was the same thing. So that was a $1 spread all day long. That's 14. So that's already 2 o'clock. Today though, it's 270, and unfortunately the sevens have only gone up to 110. They haven't gained their premium as much as the lower calls, which is why, frankly, we bought the in-the-money threes in the first place, because they gain money faster than the short calls. That was the whole point of the trade. But no, you're never going to get it now because it's too late. So just don't trade it. The point was, it was great as a $1 trade. It was a great price. You know, a lot of times we go into these trades because they have good prices on the options. And if you come at it a day or so later and you didn't do it, but meanwhile, you know, 5.9. So here's 5.9 we did the trade at 11, or we put it out at 11. So it went from 80, which was our call was 80. Went from 80, you can even get 85, you can get 80 again, you can get 90 later in the day. Then it went back to 85. I mean, everybody and their mother got fills here. On the threes, on the same day, 165, lower than we wanted, 180, right where we wanted, 190, 193, not even $2, still 194, 195, $2. But then 2 days later, 206. It's only out of control now. The point was to get a dollar spread. And if you ask to fill the spread at $1, you probably don't get it. You have to leg into the spread. You have to fill the individual legs by making a reasonable offer at where you want to be. And since we're bullish, obviously you want to grab the bullish calls first, and then if you're having trouble getting a fill, you just wait a bit and say, well, we expected it to go up, so why don't I just wait and see if it goes up? If it doesn't go up, then you can sell something and deal with it, and you have a little bit less of a spread, but that's the worst thing that happens to you. All right, when are you next on BNN? I don't know. It's up to them. You have to write in and say, why isn't Phil Davis on every day? All right, so he says, thank you. You're welcome. Brendan says, 224 on RB. This is why we're not shorting it. So you think I should close it out and mimic the OOP portfolio there? There's nothing wrong with the one you have. I'm just saying the move I would make is at the moment is to buy back the short calls and roll down to the more aggressive position. But yeah, if you want to follow the OOP, follow the OOP. It's essentially what we're doing. Brendan says 5 puts, 3-7 bull call spread. Yeah, I know about that. Brendan says, what would you do now? I would not not for $1.60. I can't pay $1.60 for a trade for a spread that I paid $1 for not even a week ago. I can't do it. I would just say forget it. It's not for me. Not only that, though, we can't even get the good price on the puts anymore. So forget it. There's always another trade. It's like, it's like when you go to Vegas, and let's say you're betting on football, and you're like, oh, I was going to bet on that game. It's like there's another game tomorrow. There'll be another game the day after that. There's a game it's weird because that's why they've done it though. They've made it so that football basically every day, because the reason they move the NFL schedule around is for sports betting, because they make so much more money. Because everybody bets on Sunday, obviously, but now everybody bets on Saturday, and everybody bets on Sunday, and everybody bets Monday night, and everybody bets Thursday night. So the more every time there's a game, even if there's only one game, everybody bets on it anyway. All the same guys are at the same sports bar, and I'm one of them. I go to the sports book. It's like you see the same people sitting there betting every single night on the games. They like to bet the sports. So, there's always another game. So yeah, Opco went well. It didn't fill so up, but next time, the point is to understand next time, if you have a thing where we're trying to fill 30 longs, think about what we're doing in the trade, okay? This goes for any trade for all you guys, by the way. What were we really doing? When we did the trade on Opco, which was the 9th, did we say? I'll tell you what I said. So fill and the 9th. I mean, it's a wonderful tool we have here because you can always go back and see exactly what was going on when a trade was made. Okay, here we are, May 9th. Now, OPK is something that a couple of guys have been trading for ages, and I've always been like, I don't really trust it, blah, blah, blah. But then I read something on that morning. So I said, look, OPK is finally catching a bid. I think this one is real now, so let's give it a try in the LTP. So what was our goal? Our goal was to be long OPK. So if that's our goal, and the 9th is this day here when it went up to $4. Can you still see it here? Let me see if we can still see it on stock charts. OPK. No, it's too old. Oh, Yahoo will show it. OPK. Oops, chart. I don't know if the 5-day chart's going to do what I want it to do. 5-day chart. Can I get the 9th? Oh, I can. Look at that. All right, here we go. Okay, so right about here is where I put in the trade. And then it took off. Here's the end of the day. So it really kind of jumped up there, and then it came back down, then it jumped up, whatever. And now it's up like a whole $1 since then. It's up it's 20%. Stock's up 20% since we did it. The point is, while it was going up, I said, I think this is real, and let's do something about it. So if that's my premise, and you're going to buy it, then logically, you want to sell the puts as quickly as possible because we're long. So you sell the $5 puts for whatever the hell we said we were going to sell for, and that's an aggressive sell. When I say sell the $5 puts and we're below $5, that I really think the stock is underpriced. We also, but then also though, if you can't fill one of the legs because the stock's going up, then ideally you want to play it like a momentum trade. You want to buy if it's 30 by 10 longs, and then wait until you can fill the short puts for $1 spread. Then you've got that much filled out. Then you look to see maybe there'll be, then you wait for a price, or you watch the chart and say, okay, so next time it comes back down to this price, I'm going to buy 10 more longs. And then when it goes up to this price, I'm going to sell 10 more shorts. That's called legging into the spread. But you want to do it not randomly. You want to do it in the way that it makes sense for the trade. We're bullish on OPCO. We have a target, and so that means that you want to start filling in the positive trades first, and then you can wait to get your price on the other ones. And I don't mean jump in with 30 longs and have no cover, because what if I'm wrong? Then you need a shitty spread. But I'm saying take a third of the spread, because if you get a bad third of the spread, let's say you got your calls for, God knows what the price was now. Let's say you got your calls for $1.80, and then it fell. Instead of going up, it fell, and they go down to 120. So now what happened to you? You have 10 longs at 120. I'm sorry, you have 10 longs you bought for 120, 180. They went to 120. But you know what happens? Because it went down so fast, which again, we're not saying it would, but because it went down so fast, that would drive the premium of the short puts higher. So they would hold their value better than the long puts, which are in the money. They'll pretty much lose dollar for dollar on the way down. So what's going to happen is at 120, the 180 puts will go to, I'm sorry, obviously they're 120. At 120 for the put, if you double down then, if you buy 10 more and you're still not even full on your position, you buy 10 more, your average of 120 and 180 is 150. So now you've averaged a much lower price, and all you have to do now is sell the same calls for 50 cents, and you're covered. And because the short calls have a much lower delta, you'd fill it. So there's really no negative outcome to this, to legging into the spread. If you leg in and it goes up, you're going to get a better fill on the short calls, and you will make money. If it and you'll have a cheaper spread than you planned on. If it goes down, you'll have a cheaper entry on the long position, and the short calls, the short calls, since they're more out of the money, will not lose their value as quickly, and you'll still get the spread that you wanted. You'll still get the net $1 spread that you were looking for in the first place. There's almost no downside to legging in, yet hardly anybody does it. Yes, you can get badly burned. It could take a horrible turn against you, whatever, but then again, that's the point. You've only bought 1/3 of the position. Thank God you didn't buy the whole thing. You have a small position, so you say, okay, that went totally against me. Maybe I'll just take the loss. There's a whole, in our top of the trade here, we have a strategy section, and there's only 2 articles in the strategy section. There's here, this is the basic strategies, right? I don't think these are links. No, they're just underlined. So here's our basic strategy, which we talk on, which I go on and on about, blah, 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 blah. So that's the basic strategy. And there's only one link. And the link is to an article on scaling in. And I talk all about scaling in and out of positions, featuring Paris Hilton and the art of war. What more culture can you possibly have in one afternoon? This is great. I don't know when I wrote this, but it's funny. I love reading myself sometimes, crack myself up. I go back and I'm like, what the hell was I doing? In 2009, I wrote that. I was a young man. Oh my God, 2009. What the hell year is this? 2018, 10 years ago almost. But there's nothing here. I mean, I wrote this 10 years ago, and I talked about these stocks. Exactly. So our entire strategy section has 2 articles, and one is about what I'm telling you right now. All right? Let's see. All right, so yes, so May, you're in charge of the writing campaign. Get everybody to write to BNN and say, where is Phil Davis? Why is he not on your show? All right. Okay, great. No other questions. Let's wrap it up. Yes. Let's just take a quick look at what's going on. Oh, we did the portfolio today. We did the OOP. I did a review, so everybody's got that. The options opportunity portfolio. It is at this moment up 50. Oh, no, wait, that can't be the options opportunity portfolio. Ooh, nice gain in the LTP today. It's like 2% since I was writing. 15.2. What the hell's going on in the market? Dow's only up 78. 15.2. So very nice. We're up 15.2% since January. So it's only February, March, April, May. So let's say 4 months. So it's up, 4% a month. That's good. I think that's fine. I don't know what you guys want. As I noted in the review, let's see where the review is. That's going to be in today's post. As I noted in this review and also in the last review when we went into much, much more detail, and here we go. What's this? Donald Tusk. All right, I can't have time for that. The world is so strange, huh? Look at this. Cartoon superhero standing next to talk show host. Here it is. So here's the options opportunity portfolio review. It was only at 1448, and now it's at, this was only a couple hours ago. Now it's at 1151. So we're up about $300-400. That's not bad. What was I saying though? There's something important here. Oh yeah. So the most important thing about these positions, which we reviewed every single one, where they are and what they are. This is not the big one. The last month, which killed me, by the way. That's why I don't do these all the time. It's freaking, the work involved is incredible. So last month, I did this. Every position, not worried. We're going to collect the rest of our $5,100, $4,688. So I wrote the potential gain of each position from where it is now. So I do that about once a quarter, so I just know exactly if we're really doing what we're supposed to do. So the thing is, with the options opportunity portfolio, when I did this one here, we had $140,520 of upside potential. And that was just on the trades that we're confident in. Because I was not confident. Let's see if I have one that I can say is not confident. I think I made them red or something. Here, FNSR. We won't count it as potentially likely. There's $13,000 that I still like the trade, but I wasn't going to count it as potentially likely. Chesapeake. I didn't count $6,000 of Chesapeake. Look what happened to Chesapeake since then, though. I would now count that as a potential winner. So not only do we have $140,000 worth of gains lined up in this portfolio, if all goes well, but what else is the point? When you buy a condo and you're going to rent it out, right? And your cost of the condo is $1,000 a month, and you say I'm going to rent it out for $2,000 a month. So if all goes well, I'm going to make $1,000 a month. That's your plan, right? Well, that's exactly what we're doing here. We're buying positions and we're renting them out by selling premium. So it's not random. I've got a spreadsheet for this stuff. I know exactly how much every position should make. And I know if my positions are on track or not on track because every position has its own business plan. And if you don't have that, what are you doing with your trading? You're not taking it seriously. Every single position, you should be able to do this. How much money do I make? How much could I make? How much should I make? And how much will I make? So once a quarter, I go through every position painfully, and I say, here's how much it should make. Only in the OOP. I don't do it for every portfolio because it's more, the PSW members are generally more advanced, and this is sort of like options basics. But the point is that I'm telling you guys at the webinar, this is basic. You've got to treat this like a real business. If you ran a restaurant and you didn't know what your operating costs were, and you didn't keep control of how much you're spending and how much you're earning and what your cash flow is, you're going to go bankrupt. Unless you're totally lucky, which some people are. I've seen restaurants run where the owner has absolutely not a clue what he makes. He just knows that there's money in the registry, he takes it out, and he's fine. Nothing bad, especially pizza guys. Pizza guys are all like that. It's like they pay for their house in cash. They're like, I don't know, we make a lot of money. I don't want to know because then I'll have to tell the IRS, so I'd rather not know. But so the point is, though, you can't run your portfolio like that, though. It's completely irresponsible. You need to know on every position, how much money am I going to make? And am I making, and then you need to sit down every quarter at least and review and say, am I making as much money as I thought I would make? And if not, what am I going to make now? What's my year going to look like? So I can tell you right now that this portfolio, as it stands here, as of last month anyway, which we haven't changed it much, is going to make $140,000 by January of 2020, if all goes well. And that includes, by the way, losing money, expected losses on the hedges. See, minus 67.50. I expect to lose 67.50 on that position. I expect to lose 3,100 on this position. That's fine. That's part of the plan. Can't all win. If you're hedging, you certainly can't all win, or you're doing it wrong. But I know what I'm going to make. I know what I'm going to lose, and I know where my gaps are. And when we review each individual position, I know which positions I trust and which ones I don't. So it's possible. Harmony, I had as a potential $12,000 winner, and now I would take that off. So one went on that was $6,000, right? Oh, FNSR, I'm not sure where they are now. But anyway, the other one, whichever one that was, Chesapeake. So Chesapeake now turns positive 6,000, but I would take off Harmony, and I would say I'm no longer going to count that 12,000 because it's now become a long shot compared to where it was. So I would say, oops, what happened? So net, if I ran through these numbers again right this minute, my net would drop to 135. Now, is that devastating? No, it's not devastating. Something went up and something went down, but unfortunately, the thing that went down was bigger than the thing that went up. But it lets me see I have a weakness, and I have to start thinking about, what do I do? How do I get that $5,000 back? How do I get back on track for what I want to gain? And by the way, making $140,000 in a $100,000 portfolio in 2 years is a little bit more than on track. But we're saying if all goes incredibly well, we'll make 70% a year, which is crazy. So obviously, all doesn't always go 100% on track. But if everything went on track, we're up for this huge. But on the other hand, though, if everything going perfectly only nets you $40,000 in 2 years, then you've got a problem, because now only your best case scenario is going to make you 20%. So that's no good. You see, so by knowing your numbers, you can see if you're on the right track, if you've got the proper expectations, if you even have a chance of getting to your real goals. So our goals are to do 20% or more a year. In this particular case, it would be tragic if we don't make 40%. These things would have to go really badly against us for us not to make 40%. And it's a plan, though. And then what do I do this month? So, okay, so we're done with that. So now this month, as I review my positions, what am I saying? Apple, not at all worried. CBI, not worried. CHL, this is a fantastic trade. FTR, Target, ABX, still good. ALK, still good. BBY, still good. So this is a lighter one, but all I'm doing is checking to make sure we're on track. And as long as they're all on track, and as long as I know that last time we were making $140,000, that means we're on track to make $140,000. I even like FSNR now. We did the thing last time, it was at 16, now it's at 17. And hopefully it's going to break out and be good. Now that one is a minus 13,000. So I could add 13,000 to my house. I could add 10% to my goal if this thing just pops over. And like I said, though, I don't stress over it and change it every month. But once a quarter, I make sure I know exactly to the penny how much money I'm going to make. And that money better be better than it was last quarter. Otherwise, I've got a problem. And then each month, I look at every position to make sure nobody's going really badly on us. And here's my big conversation on Harmony. We're down $10,000 on this position. What's our plan? If I don't have a plan for what I'm going to do about the fact I'm down $10,000, I better pull the plug and take the loss. And it's just like when you run a business. If you have a restaurant, goes back to the restaurant. My local pizza place, it's my fault. I made them make cheesesteak pizzas for me, and it caught on, and they put it on the menu. So cheesesteak pizza is just a pizza with steak and onions and peppers and whatever. But I made them make special cheesesteak pizzas for me. They were using the steak, the ribeye steak that they had in the restaurant. So when I was ordering it, I was happy. They're like really good steak on a cheesesteak pizza. So I loved it. Unfortunately, though, it turns out that as they started making a lot of them, they realized they weren't making money on the cheesesteak pizza. It was losing money because the steak was too much money. So they just took it off the menu and they won't even serve. They won't even serve it now. They stopped ordering the steak. So he went a little overboard. I'm kind of pissed. And it's not like I can order it from someone else because no one else had this was a proper Italian restaurant that also has good pizza. So he would have a nice piece of ribeye steak and he would cut the whole steak up onto a pizza. It was fantastic. Anyway, but the bottom line is he became aware. He was not aware selling me one pizza once a month maybe. So selling me one pizza once a month, he didn't notice it was a problem. And because other people started asking for it, because I would serve it to my friends would then call this restaurant and they would ask, and then their friends, then they'd have it for their friends, and it would spread like a virus through the town where people started asking for the pizza. So he put it on the menu. And he told me that's what happened. More and more people started calling for this pizza because as I would share it with people who came to my house, they would then order it at their house, and then it started becoming a thing. Because I live in a small town. That's the problem, really. So it boils down to that. But the bottom line is he did not realize he was losing money putting probably a $12 steak on a pizza. He didn't realize that was causing him to lose money. And he was charging me like $20 for the pizza, but $20 it seems like a lot, but it's not when it's got a $12 steak on it. He wasn't charging me enough more money to make it worth it. And then as he starts delivering 20 a night around town, it becomes a problem. Because all of a sudden he's losing $100 a night, and they noticed that. He didn't notice when he's losing $10 once a month to me, but when he's losing $100 a night serving it around town, it becomes a problem, right? But you've got to identify the problem. So I can't be mad at him. He identified the problem. It was my freaking cheesesteak pizza that was hurting him. So he cut it. I'm just pissed that I end up losing out. And I told him, I said, I'll pay whatever it costs. He goes, no, we're not even going to serve those steaks anymore because it's too expensive. I guess the price of meat went up also while all this was going on. But the point is, if you don't know what your numbers are, then you have no way to manage your portfolio. You've got to understand your business. And if you're trading, your business is these positions. And I don't mean the business of like, what is NAK doing this month or something like that. I'm saying your business is what are my positions in my portfolio doing? Are they on track to earn me what I expect to earn? And if they're not, they got to be corrected one item at a time. And if one of them turns out to be a cheesesteak that's not working out in the portfolio, you dice it and say, forget it, we'll get something else. And that's what that guy did, because it helped his business, because what he did is, because he realized the pizza was out of control, he went through his entire menu and cut like about 1/4 of his menu. He went through all the items in his menu and costed them out. and then he cut the ones that cost him that had the worst margin. So it's my fault. I ruined the restaurant, basically. But that's how business works, or it's how it should work. But if you don't treat your trading like a business, then it's a hobby. Then it's not, and a hobby that could cost you money. You got to care about these things. You've got to make sure you're on track, that your positions are doing what they're supposed to do, and that you know how much you're going to make. And is that money you're making enough to make it worth it for you to sit here trading? And if it's not, you've got to question the whole thing. Like, what am I doing? Like, if I can't make $500 an hour trading, if I can't make $4,000 every day trading, I could go work instead. I can easily get a job that pays me that. So I've got to be able to make that, or I'm not doing myself a service. And not everybody needs that much money, but if you $200 an hour, what could you realistically make if you went out and worked? And if you can't make that trading, then you should be working. So you've got to run it like a business. There's opportunity costs, there's investment costs. When I buy a brand new monitor and a new computer and so on and so forth, I look at it in terms of like, how much money will this help me make money trading? Will I trade better? Will it be worth it? Is it right? So in fact, I decided that like I need to, I spend more and more time in Florida now with my family. I'm going to get another computer set up in Florida. I can't keep going to Florida and sitting on my laptop. I'm more productive. I'm enough more productive on a full setup that I need a full setup in Florida. I spend enough time down there now that it's silly not to have a proper setup. Not only that, I don't have to take my computers on the plane anymore, and so on and so forth. So many conveniences to that. But it's not all about convenience. I actually look at the numbers and I say, look, it's $5,000, but I'm going to make $5,000 in 2 days. And I'm not going to make $5,000 more. But you know what? I do, in fact, when I go to Florida, I don't make $4,000 a day. When I go to Florida, I'm happy to make $2,000 a day because I'm on vacation with only my laptop and my other screen, instead of my 5-screen setup I have here. But then it says, well, if I'm only losing, if I'm losing $2,000 a day and I go for a couple of weekends a year, that's one thing. But if I'm losing $2,000 a day and I'm down there for like 2 months out of the year in combined time for 60 days, I'm losing $120,000. I'm a moron for not getting a better setup. If I can directly point to that better setup and say, if I had a better setup, I would trade better and I would make more money, then I'm an idiot for not spending the $5,000. It's a business decision. And you've got to think about this as a business. And most of you guys out there, the reason you're able to trade in the first place is because you've been successful business people at some point. And you've got to start thinking about this that way. It's not a game. It's not a hobby. It's a business. And if you treat it like a business, you can make money like a business. But you've got to take it seriously. And that's what these exercises are for, okay? So, obviously I'm not going to do a full write-up every time. I did a write-up last month, but the point is those write-ups are the key. The big write-ups that I do once a quarter are the key. You've got to know every position. Are you going to make enough money? And the members know we do this all the time. I'll flip through the portfolios and I'll say, are we on track? And in this case, I know on track to me, am I making the right amount of money? Butterfly, 11.6%, on track. 40% a year, we're thrilled in this portfolio. It's a totally self-hedging portfolio. Not only that, we only have 2 freaking positions. So we got a lot of, we're going to add more positions, but I mean, we've only got 2 positions and we're making 40% a year. If we had 4 positions, we'd be making 80%. We don't have 4 positions because the market's so volatile, we haven't been happy with it, but these guys are chugging along. And so once these are well established, we can start taking a little bit more risk. Long-term portfolio, 21.5%. So they're on track it's looking towards 60% for this year. All right. The money talk, as we said, was 70-something%, 73%. So that's fine. The OOP is, what do we say, 12%, 15%. So they're back to 14.9. And the short-term portfolio, this is the weird miracle one. Our hedges made money because every time there was a dip, we took advantage of it. We cashed in our hedges when they made a dip, and we bought more hedges on the way down, and when the market's up, and then we cash them in on the way down. We haven't used the hedges. We haven't just sat on the hedges. We keep getting in and out of them. So that's what's really throwing us off. Well, not off. I mean, off in a good way, because these should be a loss. When the long-term portfolio makes that much money, these guys should be a loss. They're not. So we actually have 75,000 here plus another 100-something thousand long-term portfolio. So on 600,000, we're already up 175,000. On 600,000 between the long-term and short-term portfolio, which are paired, the short-term protects the $100,000 short-term portfolio protects the $500,000 long-term portfolio. But on that $600,000 combo, we're up $175,000 already, which is 30%, something like that. So that's crazy. That's unusual, but that's because we've been very fortunate and made some very good timing calls for our hedges. Not so much, although the options opportunity portfolio is doing well, we don't get as aggressive with our trading in the options opportunity portfolio. There we're just more or less looking to steadily make money because there's a lot more introductory people in the options opportunity portfolio. You know, this one, I mean, I got guys following these portfolios that are hedge fund managers. So, you know, on the high end PSW portfolios, we're, you know, being much more aggressive. And that's where we are. So that's the summary of where things are. See if there's any final questions, and then we're going to wrap it up. Are you looking for markets to climb a wall of worry into the year end and then pull back before making a new high next year? Wow. So May is asking me, do I think the market's going to climb a wall of worry into the year end? So answer A, no. I think that we are going to have a sell-off, and we'll be lucky. We're going to finish lower than we are now at the end of the year. The market is overdone. It cannot justify these prices long term. So even if nothing actually goes wrong, eventually the lack of tremendous earnings growth in the next 2 quarters is going to make people rethink the prices of the market. So that's number one. So that you're saying pull back before making a new high next year. Now, into next year, hopefully, if nothing goes wrong, the earnings will begin. Don't forget, they still have their tax deferments. They're still not paying any taxes, these companies. So next year, though, after 2 years of not paying taxes or paying very low taxes, after 2 years of better earnings than they've had in the past 5 years, generally, after 2 years where the buybacks start taking effect, then the values should grow to be where they are now. So in 2 years, I think we should be up maybe 10% from where we are now. But first, we need to have a correction. And until we have that correction, I'm not going to be comfortable jumping back in. Not heavily. And you can see that too. Look at not the short term, but look at the long-term portfolio. We have 238,000 in positions. We have 369 in cash. So we're 70% cash. So that's where we are in our bigger portfolio, 70% cash. And I'm almost uncomfortable having only 70% cash, but otherwise we're missing it. 3 says he's in Daytona and it's beautiful. Yeah, I'm getting a place on Atlantic Avenue right there. Not Daytona, Delray. Sorry, not Daytona. I'm getting a place in Delray on Atlantic Avenue, right where the stores and the restaurants are. I love it. I mean, I used to live in Cliffside Park in New Jersey. I used to live right on the street on the main drag. I love it. You know, people are like, oh, it's so noisy, you're not gonna like it. I'm like, I don't care. I love like people outside and, you know, late night parties and things like that. To me, it's pleasant. I'm not one of those people. I guess I had a rowdy dorm when I was in college, but it never bothers me. Anyway, so here we are. It's 2:45, and the markets are doing what? Charts. Oh, nice recovery. Everybody's up. Wow, look at that. Look at oil. And look at gasoline. 225. That's where I said I wanted to short it too. I want to short it next week at 225. I think they're going for 230. That's going to be horrible for people paying gas. Brent testing 80. That's where you want it. That's definitely where I'll short. We get Brent 80, which I guess would be just about 72 here on oil. That's where I want to short. And so figure gasoline will go up too, so we could get about 227-ish on gasoline. We got the dollar is still pretty strong. Silver took a nice pop to 1640. And coffee is so-so, and gold, I imagine, must be up a little bit too. It's going to be YG. We've got gold. We have gold longs also. Yep, gold's up a little bit too, so very nice. Okay, all is well. I'm sorry we didn't have any very, very exciting futures trades today, but it's just, market's a little weird, so there's not much to bet on at the moment. And I will endorse going back into Nikkei short if we get back to 7,000, but we're halfway there, so we'll see what happens. And that's it. We'll do it again next week. Okay, thanks for coming, everybody. Appreciate it. Have a good day. Whoops.